So here's a riddle for you. You borrow money from yourself and you still get charged interest. That sounds crazy, right? That's exactly what happens though when you take out a loan from an index universal life policy. You paid the premiums, you built the cash value, so why then does the company make you pay to borrow your own money? Let's crack that code. So your money actually never leaves. That's the first surprise. When you request a loan, the company doesn't actually touch your cash value. The money stays inside your plan, still chasing index credits, still compounding. It keeps working for you the entire time. So where does the money come from? Where does the cash in your hand come from then? It's not coming from your account. It's actually the insurance company's money. They advance their dollars using their cash value as collateral. And just like any other lender, they charge a loan rate. Think about it. Your cash stays invested, earning potential growth while you spend the company's money. The interest you pay is basically the fee for that privilege. You're paying to keep your money working while their money covers your need. And here's the cool part. Because your money never leaves the plan, it keeps building even while you're borrowing. That's what truly separates an IUL loan from a plain old withdrawal that stops your growth cold. Now you might wonder, why not just borrow from a bank then? Here's the difference. With a bank, you face credit checks, major paperwork, and strict repayment schedules. If you ever miss a payment, we all know what happens there. It hits your credit score. Now with an IUL loan, there is no credit check. Your approval is basically automatic up to your cash value, and you set the pace for repayment, whether you pay or not. Your cash value can even keep on earning inside the policy while you use the funds, while bank loans don't give you that. Now, are policy loans always cheaper than a bank loan? That's not necessarily true. Today, an IUL loan often runs around 4 to 8% depending on the carrier and the loan type. Most banks are going to offer them from 7 to 11%, and personal loans even way more than that. But that changes with the market, of course. Sometimes the policy wins, sometimes the bank does. But the real advantage is in the flexibility and in the control, not the guaranteed rate. So next time someone asks you, why am I paying interest to borrow my own money? You can smile and say, because it really isn't your money. It's the company's money. And that's how my cash, your cash, keeps growing while we use it. That's the power of understanding how an IUL really works. But before I go, I want to give you a visual example. One that's very simple to understand and comprehend the benefit of borrowing their money versus ours. Let's say you have $200,000 of cash and you want to borrow $10,000. The interest fee, let's call it 5%. Now, let's assume that year the index credit was also 5% on $200,000. That means your account received a $10,000 credit while you paid $500 to borrow $10,000. The significance is major. It definitely is more beneficial when our money stays in our account. Not only are we borrowing and not paying taxes on that money, the interest that we're paying is going to be significant, usually significantly lesser than the interest we are going to receive on our much larger lump sum value of our account value within our IUL. And also keep in mind, worst case, if anything did happen to you, your family receives the death benefit tax-free. And if the loan is still outstanding, then they reduce the death benefit amount by that loan amount. If you need additional information, have further questions, I would encourage for you to reach out to our team at Champion Brokerage Group. We are here to make sure all of your questions are answered, to make sure you're informed and educated so that when you go to make those decisions that are most important for your family, that you are confident that you have considered all options.